Hi, and welcome back to the Money Advantage podcast. I'm Rachel Marshall, along with my co-host, Bruce Wayner. Good morning, Bruce.
Good morning, Rachel. As an attempt for us to continue to educate our listeners on different aspects of money, finance, and economics, we are proud to have Bob Fraser here today to talk about other things that are available instead of the typical stock market where people tend to turn today. Now, this will be for educational purposes only, so we want everybody to also consult their own CPA investment advisor, and that we are not necessarily endorsing what Bob has, but we have done some research with Bob, and we are confident he's going to add a lot of value to the show today.
Absolutely. Well, thank you for that, Bruce. And without further ado, we have a special guest, Robert Fraser, with us today. Bob, welcome to the show.
Hi, Rachel. Pleasure to be here with you.
Excellent. Well, as we jump into this conversation, we want to get kind of a feel for who you are before Aspen Funds. So tell us about who you are as a person and what led up to the creation and the start of Aspen Funds.
All right. Well, first of all, father of five. So they're all killing it. So that's fun. But I actually
nice.
Computer scientist from Berkeley.
Nice.
Sorry about that, but ended up starting a venture capitalized tech firm in the mid '90s and became a big deal. We ended up raising millions of dollars in venture capital. I ended up winning the Ernst & Young Entrepreneur of the Year award. So the thing really blew up. And then we got caught in the tech wreck, and I lost everything. And so it was kind of a real learning lesson in a positive way, but also in a negative way. After that, started a hedge fund. You really went into the stock market again, looking for those outsized returns, and got caught in the great crash. And so after that, I was kind of looking for something that had a little bit more control.
Yeah.
You're not just subject to the winds that are blowing out there, but you actually control what's happening. And met my partner, Jim Mafuccio, and we started Aspen Funds in 2012, and just absolutely love the business model. It is something that we can generate great returns. We're having a blast, and we're definitely in the driver's seat versus the stock market.
That's excellent. So tell us a little bit about your role specifically with Aspen Funds, and then what does Aspen Funds offer to investors?
We have 4 investment funds, 3 growth funds, and 1 income fund. And my role is really the capital side as well as operations side. So I'm responsible for managing our investors, doing the reporting, analytics, portfolio management, as well as just all operations. So I'm kind of the money and operations guy. My partner Jim is the chief investment officer, so he's the one that designed our models.
Nice. Okay, so Aspen Funds offers growth funds and income funds. Specifically, talk about what you are providing within those funds. I know that this has to do with mortgage notes, so tell us how you've married those together.
It's just such a very cool model what we've developed. I'll talk about our income fund. So what we do is we everybody's familiar with rental real estate, right? You buy real estate, you collect rents, and you earn income on that. And I did that for a while and was very disappointed with the amount of work required. The returns were never what I was hoping they would be. And so today it's kind of similar. We actually buy mortgage notes and we hold those notes, and we collect the payments. And we send that money to investors. So we pay every month. We pay 8.5% in cash. Well, not 8.5% annualized. We pay every month in cash, and we own these notes. So when we're the bank. So when the borrowers send their payments in, we're lien lords rather than landlords, if you will. So it's a very cool model. We end up being able to buy our mortgages at significant discounts. So we're buying it anywhere from 20% discount, believe it or not. So a $100,000 note we'll buy at $80,000. And that enhances the returns. We can buy down as low as 50% discounts. So we're buying a $100,000 note for $50,000, which effectively doubles your yields. And then when that loan is refinanced, so the borrower refinances their house or sells their house, we get paid the full amount. So we actually earn capital gains as well. It's a crazy cool model. The other really unique thing about this, so we're giving our investors really high returns. And I was talking to one guy who runs a really great alternative, real estate investment, but he's got a 10-year lockup. And who wants to be in an investment for 10 years? Think about that. I'm 59, so I'm going to be 69 years old before I can access this money. Who's really ready to bite that off? Well, so because we have pool right now, 307 notes in our fund. Well, we have about 3 to 6 of those pay off every quarter, where they get refinanced or they get sold. Well, we get the cash coming back. So we have a liquidity program. It's internal liquidity program. We don't have to sell anything. We don't have to go into the stock market and sell shares. We can just return cash to our investors. So we have a liquidity program built in. So it's kind of the best of all worlds. I actually started it from post my hedge fund days, and we just started this business. And a friend of mine had a settlement, a cash settlement. He's trying to raise his family and earn income, and he knew I was successful in the stock market. He says, "Bob, what can I do to earn income in the stock market?" And I'm like, "Good luck, buddy." What do you do?
Find some dividend-paying stocks that don't pay very much. Yeah.
No, they don't. Okay, EQR, super popular real estate REIT, right? 3.5%, I think it's yielding. But it's had, get this, 7 drawdowns since 2000 of 20% or more, and 2 drawdowns of 50% or more. So twice you're having this heart attack moment where you're losing half of your capital. People say, I just don't know why people would want to do something like that. It's just such a roller coaster ride and a heart attack, and in order to earn 3%. And so anyhow, I went back and I said, I think I could put something together buying these discounted notes. And I did. And he became our first investor.
That's excellent.
So Bob, the liquidity part is interesting, and it's kind of unique in this world.
It is.
But although it's always nice to have that in your back pocket, but at the distribution you're probably getting people just reinvesting or not. They're not actually liquidating.
No, they're holding it. Yeah,
they're holding it.
Most of our investors are holding it for cash flow.
Right.
And they're getting a check in the mail, every month. Who doesn't like that?
So I don't want to say that that's not good, because it's always good that you can get your money. But what I'm trying to get the listeners to understand is you're not going to liquidate because you're getting such a good distribution. That's
so true. But everybody wants to be, know if you got to buy a house or something like that. In fact, my son, my third son, just took his money out because he wanted to buy an Airbnb. I'm like, well, I don't think you're going to get the same returns as I'm giving you, but go for it.
Right.
And he took his money out, and he'll be back.
And can people invest with both qualified and non-qualified money in this?
Absolutely. It's actually very, very, very conducive for qualified investment. It's a great option for that.
And just so our listeners, we've actually done the definition of qualified and non-qualified before, but just so people know that non-qualified money, you've already paid taxes on it. And so when you put this in, then you'd only have to pay taxes on any gains that you get on it. The non-qualified would be in what people would call the traditional tax-deferred accounts, your 401ks, your IRAs, your 403bs, so on and so forth. How about UBIT generation? Any UBIT generation?
Zero.
So for our listeners, UBIT is unrelated business income. And you could, with the wrong placement, not that it's necessarily bad that you're actually paying this, but it's a surprise for a lot of people that get into certain investments. in a qualified account, and all of a sudden they do generate these expenses.
You get a tax bill. Yeah, you got to pay taxes on your IRA.
And you haven't realized it yet. So that actually, I think, is actually good. So that I'm glad to hear that.
Actually,
well, and Bruce, just to go.
Yeah,
sorry,
I was going to ask you a question, and it's probably the same one you're about to go into, Bob. But you talk about growing the money tax-free in these accounts. Is that right?
Yes. So you can definitely do that in a tax-free account like an IRA or something like that. But it's also very tax efficient. Both funds, our growth fund, I believe, generates around 80% of its returns as long-term cap gains. And our income fund, believe it or not, even there, it's still about 30% long-term cap gain. So it's very tax efficient, even if it's outside of a IRA.
So you're talking about buying some of these notes as little as 20 cents on the dollar, if I heard you correctly. And then some of them are
about 20 for the income fund. It's 20% discount, so 80 cents on the dollar. Down as low as 50 cents on the dollar, generally 50%. For the income fund. For the growth fund, we do buy at 20 cents, but that's a different strategy they haven't talked about.
So typically, then these mortgage notes, you're in senior position, correct, or a preferred position?
It's a mix. So I actually prefer seconds, and I'll tell you why.
Yeah, good. I because I saw this on your bio, and I'd like to and the website, and I'd like to know why you preferred seconds.
Oh, okay. Well, let's do a little exercise. Okay, little exercise. So, $300,000 house, right? And there's you can buy $100,000 senior mortgage yielding 4%. Okay, and I can pay $100,000 to buy a $100,000 mortgage yielding 4%. Okay, so I'm going to, it's probably a very safe investment that's going to earn 4%. I can buy a $100,000 second that's yielding 7%. Okay, and I can buy it at a 50% discount. So I'm earning a 14% yield on my second, and I would argue that it's just as protected or close to the first mortgage because of the equity position in the house. And what's more, so I paid $50,000 for a $100,000 mortgage. Now, if this guy ends up refinancing, I'm going to double my money. Okay. So the first mortgage, so traditional thinking, this is where, I love the way you guys think. It's entrepreneurial. It's out of the box. There's so much, traditional money management is kind of brain dead in some ways. They don't think about things like this. When is a second actually better? Well, there are times when it is. Now, there's times when it isn't, but there's times when it is. So we have about I think about 3/5 of our portfolio in seconds and about 2/5 in firsts. So we do love firsts, and we buy those at a discount as well, but they don't have as much upside when they pay off, but they're very, very, very safe, of course. So we like it. We like a blend.
So can you go back for a second? I just want to pause on this trajectory. And can you go back, and for a listener who might be saying, okay, you're talking about mortgage notes. What does it mean to be a lien lord, and how am I investing in the mortgage note and not the property itself? Can you just go super bare bones basic?
Absolutely.
Okay.
So you go and buy a house, you get a loan, the bank holds that loan. What people don't realize is the mortgage market is a very, very liquid market. You ever all of a sudden you're paying your mortgage and you get a notice in the mail, hey, start paying this guy instead of that guy.
All the time.
That loan was sold to another bank. So these loans are sold. Well, we buy these loans. So we just go buy them. And so we become the bank. And so you send your payments to us. It's really no different. And all that legalese that you signed in your mortgage, all that fine print, that's now our fine print. You're very, very protected as a bank. Okay. And so we become the bank. It's great. So
you own the note on the home, and then the mortgage is coming to you or to the fund, to Aspen Funds.
That's right.
So then when you talk about being as the investor in a first position or second position, explain that.
Okay, so typically you buy a house, you'll get a a loan on that house. That's typically a first position lien. And then maybe later you will go and, get a home equity line of credit or something like you'll take a second lien out. And so the second lien, you'll take some cash out. And a lot of times people originate liens as a first and a second, by the way, as well. Simply because they have the first lien at 80% LTV and, maybe another smaller second lien that takes it up to a 90% LTV. And you get better rates by doing that. So sometimes both originate at the same time, but a second lien only gets leftovers after the first lien is satisfied in a sale or foreclosure or something like that. So the first lien gets 100% taken care of before the second lien gets a dime. So it's quite a bit, quote, riskier. But again, risk is all, if there's only $1 in front of you, or $10 in front of you as a first lien, the second lien is not any riskier. So risk is really it's a huge scale of risk.
It's relative.
Yes, and it's it can go anywhere from just as safe as a first to terribly unsafe. So, massive scale of safety, where firsts are much smaller risk scale.
So, and then from that position, so you're talking about the first and second position mortgages and the risk level. You also mentioned earlier about having equity in the property. Can you talk about how you're finding mortgage notes that are profitable for you? I'm assuming that there are profitable ones and unprofitable ones to be included in these funds. So you mentioned, as I was looking over some things about Aspen funds, you mentioned that you typically are looking in the American heartland, and you're talking about discounted notes as well. How is that a part of figuring out which mortgage notes to purchase?
Yeah, sure. We buy all over the United States, so not just the Midwest, but we do like the Midwest because it really it doesn't have a housing bubble as much, and the price to rent ratio it's amazing. So the rents are double a P&I payment. So think about that. So I've got a borrower rather in his house. He's paying me $400 a month as a P&I payment. But if he quit paying that, and he left the house, he's going to have a rent payment that's double. It's not going anywhere.
Right.
Okay. So we look at things like that create stickiness. So we definitely have a very, very sophisticated underwriting model. We actually, for the financial nerds out there, we do a discounted cash flow. We look at every possible exit scenario for a note. We do a discounted cash flow for each scenario, and we weight those based on probability, based on the equity position, the borrower's credit scores, and lots of things. So we have a very, very sophisticated underwriting model, and that tells us what price to pay for a note. So I would argue there's no such thing as a bad note. There's only such thing as a bad price. So we bid on these notes. We buy them from banks, hedge funds, private investors, and like I say, do very, very safe we underwrite very carefully.
I see. So you would then end up paying less for a riskier mortgage, correct?
Oh, yes.
Okay.
Oh, yeah.
And so then you would also pay less for a mortgage that has less equity in the property.
Absolutely.
Okay.
Absolutely.
Okay.
So our yields, we might buy a low equity note. We really don't buy zero equity notes. There's too much risk there. But
especially in a second position, right?
What's that?
Especially in a second position, right?
Yeah, absolutely. Okay. So, but we do buy low equity notes, but we're going to get a 25% yield on those things. So again, the risk it's risk adjusted, right? And we don't buy a lot of those. We know they can go south. So, but getting a 25% return, it doesn't take long before that note's paid for. And again, on those notes, especially, we look at the P&I versus rent ratio. How sticky is this borrower, right? They've got a family. They've got, this has been their home for 10 years. They're not going anywhere if the rents are double what they're paying me. What are they going to do?
Mm-hmm.
They're not going to hand the keys over. So we look at non-traditional underwriting metrics that are real.
Okay. And go ahead, Bruce. There's another question that I have fitting into that, but you go ahead because I know you were on a trajectory with your questions as well.
Well, one of the things I should have done this at the very beginning, but this is for accredited investors only, correct, Bob?
Yes, it is.
And so accredited investors would be an individual with $200,000 or a family with $300,000 or $1 million of liquid net worth, and with the expectation that they would continue to make that kind of money in the near future. So one of the reasons, what I find interesting is one of the reasons that accredited investor is often needed for this is because of the lack of liquidity. But we already explained that there's quite a bit more liquidity in this than under a normal. I guess this is a Reg D situation.
That's right.
Yeah. So I just want to get that out in the open in case somebody gets too excited, Rachel, about calling Aspen funds and
right.
not accredited.
Yeah.
No, and I'll make sure that that's in the introduction to this as well. But yes, so this is for accredited investors only. And then do you have a minimum investment as well?
Yeah, the minimum is 50,000. And I am hopeful that the government, they changed with the Jobs Act. They actually introduced a Reg A Plus offering. They changed a lot of things with crowdfunding. I'm hopeful, and there's a lot of talk about changing the accreditation kind of numbers to lower the bar. It's kind of, honestly, is money really the main thing? Shouldn't it be, if somebody's got a good education and they know what they're doing, shouldn't they be able to do this if they have the ability to research it themselves? Should it really be only rich people can?
Bob, I'm so glad. Now we can get into the part that you said before the show that you wanted to get into. Now you're going to get me going already. Because my clients are just absolutely astonished when we start going into the regulations of this, where they can't put in the state of Missouri, and then the regulations in every state is different for alternative investments also.
Yeah.
And so here in the state of Missouri, we cannot put any more than 30% of a person's liquid portfolio into an alternative investment, and no more than 10% into one. And I have clients that just get outraged because they get such great returns on these and great tax efficient returns. And they're saying, who is it that the government can say what I can and cannot invest in?
Exactly. The nanny state, really they're so much smarter than we are,
Well, it's obvious that they've run up a $21 trillion debt.
Exactly.
Yeah. I'm with you, let's reduce these regulations. I understand they want to protect grandma from being taken advantage of. Right. I get that, and let's just make these regulations a little bit smarter. Because there's some grandmas that are accredited that should not be investing in alters because they don't understand it. So it's just the wrong metric.
Yeah, you're absolutely right. I think, Rachel, you said, we're adults here. We should be able to decide what level of risk or what level of liquidity we're fine with.
Absolutely. And ultimately it really comes down to financial literacy and understanding.
Acumen, exactly.
Yes. And so somebody who's willing to do the research and really understand what they're investing in should, yes, absolutely be able to figure out where do they want to put their money.
Right.
So that's part of the reason we even have these conversations, is because we want to make known the alternatives and the options for someone who might think that I didn't even know I could put money into something like this. I just thought that the 401k or my SEP IRA and just having a fund manager was the only way to be able to invest.
Right. My son is a perfect example. He's a 4.0 finance major. He's an MBA, but he's not accredited. He can't invest in these things. He analyzes them. He can write about them, but he can't put a dollar in. It's just so silly. Come on, DC, do something. Make a change, guys. Get with it. This is the 21st century.
Absolutely.
Yeah. So it comes down to a cash flow issue too. Like I work with a lot of people that have pensions, whether it's first responders or whether it's educators. Well, if you're getting a $3,500 a month pension, which is $4,200 a year, but you're not an accredited investor on the income side, but you might have amassed, done a good job of getting $400,000 or $500,000 of liquid net worth, but you cannot use that $42,000 as part of your
Oh,
Asset,
wow. Your income calculation.
yeah, your income
Wow.
calculation. Yeah, and
Nah.
it just it's another situation where people they get frustrated by being treated like they don't know anything, and they get very, very frustrated with.
I totally agree. Well, there is talk about changing it, so let's press our congressman to do so.
Yeah, we have a really good congresswoman in the state of Ann Wagner, and she's pressing for a lot for this. So I'm hopeful for this. Where are you located, Bob?
Kansas City, Missouri.
Oh, mom's in St. Louis, so
Okay.
didn't realize
Right.
that. That's wonderful.
I'm a little further. I'm out in Virginia, but you guys
Okay.
are in the heartland, in the cool part of the country there.
Paradise on earth.
Don't tell people. We don't want people moving here.
So, Bob, let's talk a little bit more about the notes that you're working with, and we can jump all over where we want in this conversation. But you're primarily focused on residential mortgage notes, not commercial? Is that right?
100%.
And why is that?
Commercial is much more cyclical with the economy. Home sweet home is right. People need a place to live regardless of what's going on with the economy. So it's much more stable, and we're also bite sized. So it gives us the liquidity. We have hundreds and hundreds of notes. We don't have one note or three notes. So it gives us just a lot of options. We know that space. There's a lot of support, a lot of vendors in the housing area and the mortgage space. So it's just very well defined. The laws are well defined. So it's just a great space to be in. And it's something that there's no, I don't know anybody else doing what we're doing.
That's great. So when you were talking then about the types of mortgage notes that you were holding, are you looking at foreclosures? Is that something that you're including in the portfolios or not?
Well, remember, foreclosures are property, so we don't own property, so we'll only buy notes, and we want to see a pay history in those notes. So,
okay.
But we do buy based on the asset. So a lot of times, for instance, a lot of borrowers stop making their payments on their note. They end up getting what's called a loan modification. So the bank works with them and changes the terms of the note or whatever. And then they start paying again. And I can show you on the FDIC.gov website, $7 billion in second liens that are in troubled debt restructure, it's called, in compliance with their terms, meaning they're paying, but it's troubled debt restructure. And once troubled debt restructure, always troubled debt restructure. It never becomes a good loan again, ever.
Oh,
and I'm like,
okay.
I hate these things. Well, I love them. And just because someone had trouble once doesn't, they had a medical crisis or divorce, doesn't mean they're bad.
Short-term disability.
And it doesn't mean it's a bad property. Okay. So if there's 50% equity in this property, I'm in, and if there's any kind of affordability, they want to keep their home, I'm going to buy that loan. So again, the traditional metrics for underwriting this stuff are just kind of brain dead. And so, there's a lot of ways that, we can underwrite these things that make sense, that is really outside of the traditional box.
Absolutely. And I think that's why it's so interesting to be able to ask these questions, because I don't think of mortgage notes as the first investment tool when I think about alternative investments.
Right.
I think most people are thinking there's a property I can invest in the real estate itself and have cash flow from that property. And so I think it's more maybe outside of the box or less common, less known. And so I think it's really important to be able to talk about different ways that you can profit from real estate in a different way than maybe you
absolutely. And I was a landlord for a while, and I'm allergic to being a landlord right now. So I think there was always some kind of maintenance issue, and I swear I put more money into that. I ended up so underwater because I didn't know what I was doing buying the real estate, and oh gosh, it's just so painful. I mean, it doesn't every holiday, I'm fixing a roof or a leak or an appliance, and I don't need any of that. So it's so much more scalable being a lien lord. I mean, when is the last time you called your bank because you had a plumbing issue? You know,
Yeah,
and
like never, right?
never. Yeah, you don't expect your bank to help you with anything, which is great, So, you just send them the money, and so it's a great business. There's a reason why the tallest buildings in the city have banks' names on them.
Oh,
It's
sure.
really good business to be in. And
we talk about that regularly as well, just that banking or being in a position of being able to be like the bank, where you have the capital, you have the cash flow, you have the interest coming to you. I mean, that's the ideal position that any person really wants to be in, so that you can be the
absolutely.
person with the more guarantees and less risk.
And I just want to say, you guys are proponents of the infinite banking model. And I just want to say, that's for any listener that doesn't know what that is, go talk to these guys and figure out what that is, because it's a way to get on the other side of the debt equation, right? The earning interest rather than paying interest, and it's absolutely brilliant. So I was so excited when I first learned about it, and everybody should do it.
Go ahead, Bruce.
Well, I was just thinking, one of the things, the concepts that Todd Langford, I don't know if you're familiar with Todd Langford or not, Bob, but when you're talking about being the bank instead of using a bank. Now, we have to use a bank for everyday transactions,
Right.
whether it's, writing a check or using a credit card to pay for something. But Todd would often say, the difference between 4% and 5%, people would say, well, that's just 1%. And in the context here is, bank might pay somebody they don't do this anymore, but they might pay somebody 4% to bring their money into the bank, and then they lend it at 5%. And a person said, well, yeah, the bank only made 1%, but no, they made 25% on their money, because 1% of 4 is 25%.
That's right.
And so that's what you're doing with these notes also, is you're accelerating this when you're buying them at a discount, because that's all you're doing. You're buying the notes, and then you're using the note as an income generator for your investors. And that, because
Absolutely.
I can hear some of the people out there of our listeners saying, I don't get these returns when you're getting a second and then or even a first position, and it's a 4% note. I don't see how you can be producing these returns. So can you explain that a little bit better than I just explained?
Sure. All right. Here's a real example. $110,000 house in upstate New York. Okay. Little tiny house. He owes $100,000 on it. He's got $100,000 first lien on that. He's paying 7%. Okay, on that note. Okay, well, that's a good investment if I paid $100,000 for it, maybe, but I actually paid $50,000 for that note. Hold it to this day. He's been paying for 5 years now. So I get $429 a month, I think it is. So it's a 7% coupon, but because I paid half, I paid 50 cents on the dollar, I'm earning 14% on that. Okay, so that's the way I'm getting these kind of yields. We really we buy down into 11% yield. We really won't buy anything below an 11% yield on a cost basis. But the cool thing about it, so we just get like clockwork, $429 a month until he refinances or sells that house. Then we're going to get $100,000 payoff, but we only paid $50,000 for it. So guess what? I'm earning 14% until I get a double. What's wrong with that? That's just a killer business. So that's the kind of thing we do all day long. We buy these those kind of notes. So that's a first. Second is very similar.
And there's two other points that I'd like to bring up is, and you mentioned this briefly earlier, where are you sourcing these from? Are you have special relationships with banks or mortgage companies that's saying, hey, I can't handle this anymore, and they're offering these to you, or how are you sourcing these on a regular basis?
We have about half a dozen major sources and major different types of notes. We just bought from a big, we just bought from Deutsche Bank a bunch of notes. So we buy troubled debt restructures, as I just said. So again, this is where a borrower had some trouble. Doesn't mean it's a bad loan. Just means the borrower had trouble. Doesn't mean they're going to have trouble. Okay, we buy seller originated, seller finance notes. So a lot of these are seller financing where somebody did a carryback, so they sell the property to a friend, that kind of thing, and they want to help the friend out, so they carry the note back, but they don't want the note, so they end up selling it to us, that kind of thing. We buy from hedge funds that end up buying a whole pools of notes from banks. They mod these notes and then sell them to us. We buy there's hedge funds that are buying properties. They're rehabbing properties. They end up doing seller financing originations. So they sell the property with seller financing in place, and we buy those notes. So we buy from lots of different sources.
So, okay, now this is a more difficult one, but I always have to ask this of our guests. This sounds like the greatest thing in the world. So what are the potential downfalls or the things that people should look for?
Not only risks.
Yeah.
Right.
Not only from Aspen, but from other places. And we understand that, you're going to have an opinion on this, but we find most people are brutally honest about the risk involved in these.
Yeah, look, I've been through the S&L crisis. Maybe you have too, Bruce. I
remember it. Yeah.
Knows what that is, but actually you probably know. But
I do.
I went through the .com crisis. I went through the Great Recession. I've been through four major cycles. Okay, so I'm, to the best of my ability, I have built a hardened portfolio here that manages high yields, but also hardened. But the risks are real, and we saw during the great housing crash, we saw prices drop 35%. Okay, across the United States. So that's risk number one. So I try and have very, very low ITVs, investment to value, meaning my cost relative to the price of that home. I love that to be in the 65% range, so that if the housing does crash another 35%, which I do not believe it's going to do, by the way, and I can tell you why. It's actually, I'm an analyst, I'm an economist, and so I don't think it's going to happen. But if it does, I'm still okay. So the biggest risk is housing price crash. So besides having equity as a safety, there is home sweet home. Just because, if your house goes underwater, Bruce, are you going to hand the keys back, right away? Probably not. Why? Because you live there. So this is home sweet home. You got kids, maybe they're in school, you got a job, you got, grandparents you're taking care of. You just can't pull up. So we love home sweet home. The other risk is economic risk, meaning the economy, separately from the housing price crash. So housing prices, I think are less of a risk to our business model than just the general economy. So if the economy has a big recession, massive layoffs, we're seeing, I don't know if you're tracking some of the unemployment statistics. Do you realize that we are now setting a record every month for low unemployment rates in the blacks, amongst African Americans, amongst Hispanics, and the general populace?
Yeah.
Well, that means, that's great for me. But if we ever had a situation where unemployment rates are back up in the 10% area, that's trouble, because people that don't have jobs can't pay for their homes. So those are the two major risks: is recession risk and housing price risk.
Well, I'd like to bring up a point, though, before you go any further on that, is what we're talking about is a non-correlated risk to the stock market.
Absolutely.
So here's the thing. It's impossible to take a position where there is no risk. And people say, oh, no, I can stick my money in the bank. And but then you actually have inflationary risk there.
That's right.
Then you look at the devaluation of the dollar as a whole. Yeah.
And then a person says, I can stick money in my house, I can put it into my mattress or something. Well, not only do you have inflationary risk, but you also have risk of it actually burning and losing it.
Bruce actually had happened to him.
I actually lost my house to a house fire, but I didn't lose I didn't lose any
You
cash.
didn't lose the money under the mattress?
No. But my point is that we have been conditioned to understand their stock market risk, and people say if you just stay in it long enough, you'll prosper. But for some reason, when it comes to other things that are not correlated to the stock market, we don't accept the same boom and bust cycles in those also, and in the housing market, which whether you hold physical houses or whether you hold notes in those houses, it's the same boom and bust cycle.
Yeah, that's right. That's totally right. I couldn't agree more. And and just to emphasize the point, uncorrelated means if the stock market dropped 90% of its value tomorrow, okay, my investment is fine because I'm uncorrelated to that.
Right,
Yeah.
right.
Now, if the economy or the housing prices drop, now I'm gonna be a little more at risk.
But
so yes,
again,
you're uncorrelated with the stock market. That doesn't mean there's no risk. And I think, Bruce, I think you did an excellent job of painting that picture, because we certainly don't want to ever say there's an investment you can get into that is zero risk, because that is not true.
No,
absolutely. And Bob painted a great picture about that. Bob, anything else about the general economy, whether it's the U.S. economy, the world economy, that you'd like to comment on?
And I actually study this. I've written an economic newsletter for many years, and actually I'll make it available to your listeners. My economic deck I adjust for my shareholders every quarter. But the economy, there's a lot of fear out there, but the economy, in my opinion, we are not going to have a recession in the next 2 to 3 years. Not when you look at 70% of the economy being consumer spending, and when you see consumer optimism as high as it is, it's setting records right now, and you see the unemployment rate as low as it is. And what I love about this unemployment rate, even the U6 rate, which is the broad rate, it is setting records. As I said, African Americans, Hispanics, it's touching everybody, including those at the really lower end of the spectrum are getting jobs. And people with jobs spend money. And people that are optimistic spend money. So bottom line is, when you're seeing that kind of metrics, the recession is simply not possible, with that being 70% of the U.S. economy. So generally the economy is going to continue. Real household income on an inflation adjusted basis is setting records. So it's a real good time for the economy. And again, that's just not going to change. It doesn't change on a dime. So I differ from some of the economic opinion out there of, recession fears. It's simply not going to happen, not in the next couple of years. I'm also bullish on the housing market, and believe it or not. And the people are stunned when I say that, but I run the numbers. And, housing prices are still 25% below the peak in terms of inflation adjusted. So inflation has kept rolling. Housing prices have been in a massive correction, massively upside down, and there's still a lot of room for them to run. The price to rent ratios, as I've been pointing out, are very, very bullish for housing. Single family homes have been massively underbuilt. This housing starts still are not even anywhere near where they were in the heyday of the late 2000s or the early 2000s. So bottom line is, housing is going to continue to go up. Now in the coast, I don't think it's going to, I think it's going to more, bump along. But certainly in the Midwest and other lower price real estate, we're seeing a very, very tight market, very, very much a seller's market.
Let's talk a little bit about, I'm sorry, Rachel, go ahead if you had a thought.
You're fine. Go ahead, Bruce.
Talk a little bit about your educational webinars that are on your site for our investors.
Yeah, well, we have a webinar that kind of goes through the Aspen Fund's offerings there, and as I said, I'll also make our economic deck, which is just general economic analysis, which we update quarterly. Make that available for your listeners as well.
And the final thing, then, and Rachel, then you can go ahead with your thoughts. But you mentioned, and we've mentioned this before about net asset value. So I don't want to go through this again in my words, because I know coming from somebody else, it'll probably somebody else will click with it. So can you go over net asset value and the calculations you use for your fund?
Okay, well, we're going to nerd out a little bit here.
A little bit.
So net asset value is simply what we pay for all of our assets, so summed up. So, and it's adjusted by any payments the borrowers make. So if they pay off a note, well, that reduces the value of that asset, but increases our cash. So basically, I calculate a net asset value per share every quarter, and that's basically the number of shares owned divided by the total net asset value, which is simply an accounting term, and that comes up with a net asset value per share price. And that is completely uncorrelated to the stock market price. It's by accountants, and so that's the price at which we allow an investor to redeem at, or to put new money in it. So every quarter we open the fund and we allow investors to take their money out or put money in, and that's the price. So it's basically accounting driven price based on our cost.
Yeah, it's an accounting driven. My key point here is an accounting driven price. It's not a speculation driven price.
No, it's not a market price. It's not what someone willing to pay for this. I think if we put this thing on the stock market, the price would double, because where you're going to earn 8.5% returns, in the stock market, for something. So, and that wouldn't benefit anybody, to do that, to have to go up. So we don't do that. We're not on the stock market.
Right. And I brought that point up because this is an educational thing that I don't think enough people realize when they look to get into this alternative world. They look at the net asset value price as being a market price, and it's not.
Not at all.
That's
why it's not volatile. So our price is simply not volatile, because it's simply based on accounting costs.
Now, one of the things I like to tell the listeners, because this is what our E3 wealth model here in St. Louis is, we do a lot of alternative investments, and most of your typical investment portfolios are looking for appreciation. So they're looking for a model of a market price that they can kind of, beat. Well, if markets are efficient, I don't know if you can ever really beat a market price, but that's the game people try to play. But if you're looking for wealth accumulation by income, well, that's when you're looking for something with a net asset value that's kicking off an income for you. And then you just, instead of looking for appreciation, you're looking for income to build your wealth. And it's much more of a steady, and in many people's opinion, much more predictable. Yeah,
absolutely. Yeah, I can show you my net asset value price, and it's kind of boring. Which is nice, I don't give anybody any heart attacks, when they open their statement,
That's thankfully. Awesome. That's awesome. And I think that really plays into the whole idea as well of building your income from assets. So cash flowing assets, and that's where you build financial freedom. We talk about having time and money freedom. When you have income from your assets that's greater than your expenses, you're in a position where now you can control your time and not have to work, but you can then choose to work and provide that value because you love to and want to do so. So this has been a fabulous interview today. I know one thing I was going to ask you about, there's a question here. What sources are you personally reading for hours every day before you make investment decisions? And I know that this is really going to play into the credibility of Aspen Funds and you guys as you're making these investment choices.
Yeah, well, for whatever reason, I'm a massive consumer of information, and I read the Wall Street Journal cover to cover every day. I read The Economist. I read Financial Times, so I really love a global perspective. I read most of the big research reports coming out of the banks, like J.P. Morgan and Bank of America. These guys, because I want to Goldman. I want to know what they're thinking about the economy. They're usually very, very smart guys, and so I want to know what and the more I read, the smarter I get, because they differ in opinions. And so then it makes me think about, who's right and why? And then I spend a lot of time actually do my own research. I spend a lot of time on the Federal Reserve economic data website, getting my own data, and I chart that and change the trends, or chart the trends over time to see what's changing. Because the truth is, it doesn't change that rapidly. The stock market goes up and down. It's hugely volatile, but the economy is just this massive, massive machine. It does not change on a dime. So, I like to catch the tides, right? Not the waves. I want to know, when the tides come in, all boats float, right?
Mm-hmm.
And when tides go out, all boats hit the ground. So I'm really pay a lot of attention to the large macroeconomic forces is what I'm looking at. But I love reading like this and getting diverse opinions and really thinking through who's right and why.
That's excellent and really says a lot about you as a person as well. So thank you for sharing that today.
My pleasure.
So how can someone reach out, connect with you, connect with Aspen Funds, and find out more or get information about investing with you?
We'll give you some links to post on the show notes for this podcast, and our website is aspenfunds, funds.us. And we have all that information there. And we'll post a special link for your listeners as well, where they can access the economic forecasts and other things.
Excellent. Well, thank you so much. And in closing, is there anything that you would like to share with us about you personally and your experience in building time and money freedom or building a life and business that you love?
Yeah, I'm a big Warren Buffett fan. And his most recent letter, I thought was just fantastic. There's so much fear out there. And I think fear is our biggest enemy, from making money. There's always something to be worried about, okay? Always. It's never been any different, right? The economy, the Washington, D.C., the Russians, the Chinese, who knows, right? Let's just buy gold and let's just stick it in the ground. Well, it ends up not being a very good investment over time.
Oh, yeah. I've learned that lesson personally. Yes.
Yeah, he said in the last 77 years, had you foreseen the rise of the national debt and these things and put your money into gold, you would have 1% of what you had you simply invested in the stock market. In spite of multiple wars, I think he said 7 Democrats and 7 Republicans. In spite of impeachments you still would have had 100 times more money in the stock market. There's just, and I'm not telling everybody to get in the stock market, but the point is get in the game, get in the system, right? Don't just hide out. So that's what I would say. Fear is your enemy. Fear is your enemy. Get out there, make some good choices, make a mistake or two, and move forward.
And it sounds like they're not mistakes when you learn the lesson. So I like that.
That's right.
Awesome. Well, thank you so much to you, Bob Fraser, for being with us on the show today. And absolutely, we'll have those links in the show notes and ways that you can get in touch with Bob and also with Aspen Funds to find out more. So in closing, remember, success leaves clues. So model the successful few, not the crowd, and build a life and business you love.